Welcome to The Explainer. You know that feeling, right? You open up your brokerage app, the market's dipping, a sea of red is flashing back at you, and suddenly it just feels like total chaos. But today, we're actually going to chart that chaos. We're cutting straight through the emotion, putting the blinders on, and looking directly at the technicals to uncover exactly what the market is trying to tell us right now.
And really, that brings us to the main question our source material is tackling today. Is this a crazy pullback or just a bullish stip? It is so incredibly easy to slip into full-blown panic mode when a stock closes down, say, 3%. Your brain immediately screams, "That's it, it's all over, we're crashing." But, as we'll see today, when you zoom out and mute that short-term noise, a drop in price doesn't automatically equal some bearish apocalypse. Actually, it's often exactly what a healthy market needs to build a solid foundation for its next leg up.
So, here's our roadmap for this explainer. First, the broader market picture. Second, Tesla's bullish pullback. Third, retail favorites in limbo. And fourth, high flyers and risk management.
Okay, let's dive into part one, the broader market picture.
Before we get into the weeds with any individual stock, we have to gauge the health of the overall market. And right now, it's basically a tale of two traders out there. On one hand, you've got the leveraged and scared trader. You know the type. They panic at a tiny 1% dip because they're in so deep that even a minor drop could literally wipe out their whole account. But then, on the other hand, you have the prepared and excited trader. This is exactly where we want to be. This trader has their levels marked ahead of time, and they're genuinely pumped to buy a 3% drop. And the reason the prepared trader is winning right now? It's because despite these recent dips, the big indexes like the SPY and QQQ have completely maintained their euphoric momentum. The bulls are absolutely still driving the bus here.
Let's look at the data backing that up. Both the SPY and QQQ actually held their 9 EMA on the daily close. That is a massive indicator of sustained strength. Our source analysis points out that the absolute maximum expected downside right now is roughly a 3% drop. And honestly, a 3% drop is nothing more than a standard bullish pullback. Plus, look at the VIX, the volatility index. It spiked up to its 50 EMA, but got fiercely rejected. Sure, a short-term push to that 20 to 22 range is totally possible, but the technicals suggest it's just going to round off and head back down. Basically, the lid is still firmly kept on market fear.
Moving right along to part two, Tesla's bullish pullback. So, Tesla recently had a day where it closed down about 3%, resting right around that 410 level. And yeah, it caused a lot of panic online. But technically speaking, a bullish pullback is just a market movement where a stock drops into deep support, turning old resistance into new support, all while momentum indicators, like the SMI, finally get a chance to cool off into the green zone. This perfectly describes what's happening with Tesla. For weeks, it was fighting severe resistance in the upper $390 to $420 range. It just kept hitting its head on the ceiling. But now that it's broken through, that old stubborn ceiling has basically become a new concrete floor.
And the technical evidence for this new floor is just, wow, it's beautiful. The source highlights this massive confluence of indicators all stacking up right around the $407 level. You've got the 21 EMA sitting at approximately $407. You've got the huge 200-day moving average right there at $407. And as if that wasn't enough, the 0.5 Fibonacci retracement level lines up there too. When you get this many powerful technical indicators forming a massive support zone at the exact same price point, it is literally a textbook setup for a bullish continuation.
But you know how the market is. We always have to be ready for some shenanigans. Keep an eye out for potential dip into the high 390s to sweep the lows and retest the trend line. That wouldn't invalidate this bullish setup at all. Honestly, it's super common for a stock to try and shake out the weak hands. You know, the folks who smash the sell button the second they see a red candle. So we might see a dip to $400 or $395 for a deeper support test before it ultimately rounds off and rockets higher. The takeaway here, stay incredibly patient. Whether it bounces at 407 today or dips to 395 tomorrow, the overall structure is still highly supportive.
All right, part three, retail favorites in limbo.
We're pivoting now from the mega caps over to the mid-cap names that the retail crowd loves. A lot of these are currently trapped in descending trend lines. But before we get to the tickers, think about this number, 76,000. Over a recent weekend, Bitcoin took a massive tumble all the way down to $76,000. Why does that matter to us? Well, because a stock like Robinhood, ticker HOOD, is super closely tied to crypto sentiment. With a Bitcoin drop that severe, you'd expect Robinhood to get absolutely destroyed on Monday morning, but it didn't. It actually managed to close flat, maybe even arguably a tiny bit green. That resilience is a huge, quiet win for the bulls.
So, what's it going to take for these retail favorites to officially break out of limbo land? For Robinhood, it's currently stuck in this really tight falling wedge. But here's the cool part. There's actually a bullish divergence on its SMI indicator. That means momentum is quietly building up, even while the price is just chopping sideways. It needs daily closures solidly above $80 to $82 to start targeting $85 and beyond. Now, because Hood and SOFI kind of moved together, SOFI is also trying to find its bottom. It's pinned under a descending trend line right now and really needs to clear $16.12 to wake up. And then there's Palantir, PLTR. It's been struggling, consistently getting swatted down by its 9 EMA for weeks. It desperately needs to reclaim the mid-$13 to mid-$14.
For Palantir specifically, the source actually lays out a very deliberate, step-by-step roadmap for it to become a great play again. This isn't just going to happen by magic. Step 1, it needs a very solid pop-up to the 21 EMA. Step 2, it has to come back down and successfully turn that 134 to 135 region into hardcore support, maybe forming a mini head and shoulders pattern there. And finally, step 3, it needs to break cleanly above the mid-140s. That's the move that would finally shatter the larger falling wedge and give us a true breakout signal. Until it does that, well, it's just a waiting game.
And finally, part 4, high flyers and risk management.
That theme of patience we just talked about, it is absolutely critical when we shift over to these highly volatile semiconductor names like MU and SNDK. You have to use a totally different trading psychology here. These stocks were just incredibly extended from their 9 EMA on the weekly chart, like off the charts euphoric. And when that happens, the risk-reward ratio just completely falls apart. So recently, they lost that 9 EMA and bam, it triggered some really rapid downside. As of right now, the charts are showing zero signs of a daily bottom. No bullish engulfing candles, no reversal signals, nothing. We are likely looking at a solid 1 to 2 weeks of sustained downward pressure, or at best, just sideways chop. Please, do not be the trader who buys these right now just because, hey, they dropped 6%. There's no structural reason to jump in yet.
So where do they actually cool off? The analysis gives us some really specific target zones to keep an eye on. MU could realistically fall further to retest the $630 to $640 range, which lines right up with its 21 EMA. And SanDisk, SNDK, might actually need to drop down and retest that big psychological $1,000 level to finally find true breakout support. These high flyers just need time to set up their next move. There's absolutely zero reason to rush in and try to catch a falling knife.
It really all boils down to this incredible point made in today's source material. Sometimes patience is the difference between a good trade and blowing your account. That is literally the golden rule of technical analysis. Whether you're waiting for Palantir to finish its 3-step recovery or you're waiting for MU to build a solid base around $64, waiting for that actual technical confirmation is the only logical, sustainable way to play this.
Which leads me with a question for you to chew on as you look over your own portfolio today. Are you trading with deliberate patience, marking your levels and waiting for that perfect confluence? Or are you just hitting buy because a stock is down and it feels like a discount? Charting the chaos isn't about having a crystal ball. It's about managing your risk, knowing the difference between a normal bullish pullback and a completely broken trend, and having the iron discipline to wait for the setup. Thanks so much for hanging out with me for this explainer, and I hope this helps you tackle your charts with a fresh, disciplined perspective.